I was formerly an oil trader and has been active in the crypto scene since 2018. So my work evolved around the exchanges and also the Web3 projects. So it's just a moment. Okay. So yeah. So not sure if everyone has seen or had been following the news because recently for Wednesday, the US just published their CPI, the news of 9.1% increase year on year in June, which shows the accelerated growth of inflations. So likely what's going to happen is the Fed is going to go all out to fight inflation, right? So market is expecting about 50 to 75% basis point kind of increase, but there is also a chance that 100%, also 100 BPS increase as well. So with such aggressive move, if not well handled, likely there'll be a recession that's coming for us. But anyway, we are already in the bear market. So yeah, so I'm going to start off. But before we start, please do take note, everything that we shared here today is based on my personal experience and opinion. It's not financial advice. So always do your own research before engaging in any form of investment. Okay. Okay, so 101 to survive in a bear market. So over here, we will cover some rules of engagement in order to stay alive in this bear market. So over here, I'll be sharing 6 points, which will help you to avoid taking unnecessary risky bets and survive. Because most importantly is to survive before you can try to take care of any opportunity in the futures. Right? So the old proverb always says, better to be safe than to be sorry. Then you can survive to fight another day. So the first point, to understand your risk appetite. Then you also need to protect your capital. Avoid leverage trading. Avoid meme stock and crypto, and inclusive of the NFT. Avoid staking or lending. And last but not least, diversify your portfolio. That is a very important point here. So these will be the 6 rules of engagement for you to survive. So by understanding your risk appetite, it will help you to also better allocate your capital to structure your portfolio. So over here, I've listed 4 different asset classes based on their volatility, having cryptocurrency being the most volatile, followed by FX, stock, and bonds. So everyone here has a different level of risk tolerance. So, I mean, this will help you to determine how you should craft your portfolio. So person with lower risk tolerance, I mean, it's recommended more towards a less volatile asset like bonds or even dividend stocks. So may I just ask here, anyone here is exposed to only one asset class, or you have more exposures? Okay, it's good that you have multiple exposures, right? Because if you are only exposed to one asset class, I think your portfolio is pretty high risk, right? It's always good to have multiple exposure. So protecting your capital in this adverse market is highly critical to survive, right? You will have to always assess your market condition and stay liquid in stable yield asset. So these are some ways to help you to reduce your risk exposure in this volatile market, and while also growing your portfolio. So such as treasury bonds. Right now we are looking at about 3% for US treasury bonds. Then there's also blue chip dividend stock, which you can safely collect consistent return. And anyway, for dividend stock, they are well regulated by the respective regulators. So it's pretty safe as compared to staking. You may run the risk of being trapped, right? Unable to withdraw or even instead of hacking. So last but not least, also maintain some liquidity in cash and stable. This will help you to take care of your day-to-day expenses or even capture opportunity when the time arises. So just like I did mention about dividend stock, but why dividend stock? So according to historical data from Fidelity, right, dividend stock account for nearly half of the returns over the last 30 years. And do take note, this whole time frame actually include three significant recession as well. So meaning to say, over the extended period of time, history show that dividend stock is also a worthy investment selections. Right, but for myself, my personal recommendation is a Singapore dividend stock will be much better, and I will share with you more why Singapore dividend stock is better than the US dividend stocks. So why Singapore dividend stock? I mean, number one, top of the list, because there's zero dividend tax, right? As compared to the US counterpart, they have for a non-US person, they have to pay 30% withholding tax on payment from US stock dividends. Then secondly, we are being in a very political stable country, well regulated by the MAS. And also, we are less volatile than the US market. You see less volatility. Everything here is very stable. So comparing 0% and 30%, which is a better choice? Definitely a no-brainer. The Singapore would be a much better place. So I did a screenshot from dividend.sg. So this is top of the list for the blue chip dividend stock. As you can see, the very common or well-known brand, Yang Zijiang, Keppel, OCBC, ST, even DBS, and UOB. If you take note, the yield they have published is definitely more attractive than the treasury bonds yield right now, and even some of the staking protocol. So over here, just to find out whether you are a trader or an investor, right? Actually may sound a bit confusing. And whether you should be a trader or investor, allow me to distinguish the difference here between the two, right? For traders, typically there's two type of traders. We call it a day trader and a swing trader. For day trader, basically they take a day-to-day perspective in trading. They have a very short time frame and very small targets that they're looking at. They will close their position before the end of the day. So they will typically hold their position within maybe minutes, 2 hours. A very common day trading strategy will be scalping, whereby traders will enter position within split minutes or seconds just to capture very small movement of the market. And they did it multiple times throughout the day. That's for day trading. So there's another type of trading patterns called the swing trading. This one will be more of a midterm approach. They have a longer horizons to their price targets. They look for a larger profit margin as compared to the day trading. So when they trade, they are looking at the market cycle movements, and they are looking for holding between days, weeks, or even to months. So on the other hand, investors is much different. They have the longest horizon as compared to the traders. They really plan very far ahead, and they will have to spot opportunity in terms of in time of crisis. Why I say that? Because this is where you make the biggest growth. Because when you spot crisis, when people are selling hard and you're trying to get in at the bear market, I think that is where there's room for growth when the market revert back to the mean. So for investors, they seek for capital gain from large market movements. And this definitely take a lot of time, because you can't just enter today and expect the market to swing 200, 300%. This is not the way it is, right? Maybe crypto does that, but if in the long term, it does not apply. So mean to say, having more trades actually does not really give you more profit. So if you want to have more profit, sometimes it's better to be patient and wait for your market to recover. Well, have to be patient to wait for reversion to mean. Okay, avoiding leverage trading is also one thing, right? Leverage trading is pretty dangerous if you do not understand the mechanics of how it works. So it may work against you. Definitely, I will not recommend it for anyone who is new, because trading leverage requires a lot of discipline and deploy a strict risk management rules on your entry and exit. And also, if you are being emotional, especially you're losing a trade or you're worried that you might not take sufficient profit, it will jeopardize your judgment also, right? And what we always see is crypto on the Twitter. We have seen a lot of crypto influencers like to show off their portfolio, how much they have made through leverage trading. But honestly, we won't know how much they have busted their account as well. So always try to be prudent and invest only in what you understand. So for leverage trading, the good thing about avoiding leverage trading is it will help you to reduce your probability of being liquidated or even exponential losses, because when you are trading leverage, you are multiplying the risk of losing more. And of course, on the other hand, you may say that, hey, I'm losing the opportunity for exponential gain, but well, there's always opportunity elsewhere. It may not. I mean, you may not need to deploy leverage on this. So meme stock and meme crypto as well as NFT is something that's also recommended to avoid, because these instruments are largely driven by the cloud of influencers and community without assessing the fundamentality of the project or the companies or even the technicalities. So it's very much like a pure gamble, to jump in very recklessly and face the risk of buying in at higher price band. So what happens is, if you FOMO to buy in, you might land in the higher price band and become the exit liquidity of the others, right? So these are highly volatile and very unpredictable. So I'm sure everyone knows who have been messing a lot with Dogecoin. Elon Musk, right? So every time you like to tweet about the Dogecoin, like, I think Dogecoin is the future. I mean, we over at Tesla, we start accepting Dogecoin as a payment and things like that. So it's very, very manipulative. And this is the same for GameStop, especially when Wall Street Bets has done similar multiple times over and over again. So how volatile these instruments are, right? I have a daily chart here for Dogecoin. So if you notice all this long wick, right, it actually shows you how fast the market turns within the time frame. It can be shorter because this is a day chart. They can turn within minutes or hours, right? And definitely you do not want to be, entering at the extreme ends of the candles. You'll be in very bad shape. Here's the daily chart for GameStop. Similarly, but for the stock market, 20% movement actually is considered very rare, and especially for one that doesn't have a very strong fundamental and sound business model. Then it's based on pure market hype. Then it's very risky as well. So anything that you are really unsure of, actually just avoid it. That will be your safest options. Staking protocol? Anyone here thinks staking is very safe? Or is there anyone that's highly involved in staking?
Just staked on Bybit's USDC 5% product. That's the only thing I've done so far.
USDC. Okay, I think the high yield staking have been the center of attractions for 2022, right? Not because of the beta, but because of the Luna and the UST. I think a lot of people has been affected by the staking of the USD, whether it's on a centralized platform that offers 5%, or it's on a decentralized directly with Luna that offer you 20%, right? Don't get me wrong, definitely there's a number of good staking protocol out there, but always look out for the red flags of the bad actors if you really choose to participate in any of them. So over here, I've listed out some of the red flags, to spot for the bad actors. Whenever, especially when there's an unrealistically high yield, I would say example would be for the Luna and USD 20% without having a viable business model, how do they pay out this 20%? I mean, I was talking to a friend a week before the collapse, saying that, hey, this really sounds like a Ponzi to me. And 1 week later, the things really collapsed badly. So always look out if the protocol have a sustainable business model. So illiquid trading pair will also affect the way you exit. So some of this staking protocol, they purposely create a illiquid pairing for you, so you can enter but you can't exit, or the bid-ask spread is pretty far away. Then long lock-in duration is also one sign of they're trying to keep you in if they do not have something in plan for you, or receiving you in a different token. This might be something you want to look out for, because the token that you receive may not be equivalent in value, or they may not have a liquid trading pair for you to cash out on as well. So staking and lending can be risky. Why is risky? Because I'm sure everyone here have seen the recent news on Celsius filing for bankruptcy protection. Not just Celsius, there's also the Voyager filing for bankruptcy protections, right? So unlike traditional fixed deposit savings, right, provided by the bank and the financial institutions, these protocol are purely, for those traditional deposit, they are protected because they have a deposit insurance that protect the principal sum. But for this protocol, they are solely governed by codes. So it's pretty risky, right? So just 2 days ago, Celsius also filed for bankruptcy protection. So what happened and what does it mean by being bankrupt? It means that the crypto deposit are not insured and user may not have access to them after that. So when it happens in a bankruptcy issue, the secured creditors become the company first right of claims. So anyone else, including the unsecured creditors and the clients, become the last priority. So eventually, after claiming out the assets, they may left nothing for the users. So this is something to take note of, the risk in participating in staking or lending protocol, right? Not your key, not your money. Well, next, so risky, I would say I would classify most of them to be risky, because if you read the fine prints of Nexo, the deposits are not protected. You have to bear risk. You have to understand the risk factor as well. So always read the fine prints. There's a lot of fine prints in all these staking protocol, lending protocols. So take note of all this, right? So staking protocol, DYOR. We always say do your own research, right? But no one can help you here, because this is your own money. You manage your own money. You have to be very cautious on this. So the point number one, to do your own research, I would say smart contract. Look out for smart protocol with smart contract that's audited by reputable firms like Certic, Slowmiss, Consensus Diligence, and even Quantstamp. There's a number of reputable one in the market, but these are the four I trust more. Then secondly, make sure the staking protocol is pretty reputable and they have a docs team behind. At least you know who's the one running the projects. Third, the revenue from the protocol should be sufficient to sustain the level of yield that they are giving out. Otherwise, it's just a Ponzi. And fourth, how long has the protocol been running without any bug or hacking incidents? I think this gives a lot of confidence to the user as well. Okay, now diversification actually will help you to spread your risk across different assets. So earlier, shared, if your exposure is only to one type of asset, then your portfolio is risky. So over here, I will be sharing 3 different diversification profiles with an objective in mind, right? So if your objective is to preserve your assets, I would say you have more likely to stick to a more conservative profile. And if you were to want to go for a balanced risk and gain, you have to have a balanced portfolio, balanced profile. And if you want to maximize your capital growth, then you may want to deploy a aggressive growth profile. And however, do take note, right? All these ratio here, they are not fixed numbers. They are only used as a reference. So when I say conservative profile, meaning to say you can allocate more of the resources to less volatile instruments like bonds and in cash. Okay, would you include commodities? Well, I would say commodities is pretty volatile as well. I think commodities should be somewhere in the same category as stock as well, right? You can include commodity in your portfolio as well. Maybe let's say you want to have a balanced portfolio with 5 different asset classes. You can have crypto, you can have commodities, you can have stocks, bonds, and also holding some cash as well, right? There's no right or wrong. It's just how you want to diversify your risk. We always say never put all eggs in one basket because if you drop the basket, you may crack all the eggs, right? So beside diversification by the asset classes, you can also diversify by spreading your risk across different sectors. Of course, this applies largely to stocks and commodities, right? You can also do that for your dividend stock or growth stock, right? But I think there's no point doing it for diversifying across for crypto, because what happened is when the king of cryptocurrency, Bitcoin, drop, likely the rest of the altcoins will follow as well. And it may be even worse. Let's say Bitcoin drop 5%, you might be seeing 10% or even 15% drop across the other altcoins. They'll be more volatile. And because the market cap for crypto is really small as compared to the traditional asset classes, the price swing can be pretty big. So now that we have covered ways on how to defend yourself against the bear, right? So it's time to share how to take an offensive approach to tackle the bear. So I will share 3 methods: long-term value investing methods, right? A dollar cost averaging method and a delta neutral trading methods. Okay. Would you allocate NFT separately or same as crypto? I would say avoid NFT because the kind of liquidity in NFT is very different from cryptocurrency. For cryptocurrency, at least it's more liquid. I will refer to the larger cap crypto like Bitcoin, Ethereum, or maybe Cardano or Ripple, right? At least when you enter a position, you exit position instantly. But if you want to enter and exit an NFT instantly, it's almost impossible. You have to place it up for sale and wait for it to sell, unless you're selling at a much lower price than market is. I hope that answer your question, Nathan. Okay, so for value investing, so what is value investing? Actually, it means to buy asset that is trading at a significant discount than what it is actually, right? So how do you do that? You do that by assessing companies or asset that's actually have a very cheap valuation that's not justifiable over a long time. So a very, very easy example here that I'm going to quote you, right? So if let's say Apple stock today is trading at $100, will you buy the shares? Definitely you will. I mean, it's a no-brainer because you know the long term, the value is going to be up, right? There's going to be a mispricing here. That's the reason why it's pricing at $100. So having to say that this approach requires a very contrarian mindset, and it's more of a long-term horizon mentality. And over 100 of years, a value investment strategy has consistent history of performing the indices. And this method has been adopted by Warren Buffett as well. I mean, he always buy into crisis. He see crisis as opportunities. So there's a lot of articles and books on value investing. So how do you spot the undervalued stocks? Well, these are some methods that may help you to identify the undervalued stocks. So the first one would be a sudden fall in the prices, right? Well, it can be for many reasons, right? A company stock can fall for many reasons, including that of a release of a quarterly financial result that fails to impress or meet the market expectation. So if the price fall by more than what is justifiable and where the company fundamental is pretty much intact, then it may be classified as a candidate for undervalued stock, right? Then the second thing is if you notice that this company has a consistent growing earnings, which has been maybe more than the last over the last 5 years, right? And they have a very sound business model and they offer a lot of growth potentials. Then that might be also another candidate. Low PE ratio of 15, right? PE ratio actually tells you it's price earning ratio, which tells you how much an investor is willing to pay for $1 of the company earning. Therefore, a higher PE ratios might actually mean that if the investor will take longer period for them to recover their initial capital. So company with lower PE ratio, they are often considered to be value stock because the price trade lower relatively to their fundamentals. And this mispricing will be a good bargain for most investors. And before you know it, the market will correct. Then the fourth one will be the price to book ratio. This price to book ratio will compare a firm market cap against the book value. So the price to book ratio signifies the number of time a company market price is greater than the book value of the equity. So when the PB ratio, when we say is less than 1, it means that the investors believe that the firm is underutilizing the asset profitably, right? So if they will use it properly, I think it might even have a better outcome. So number 5, high dividend yield, something to look out as well. It tells you how much a company dividend payout as compared to its market price, right? So a high dividend ratio may mean that the company is undervalued. But always remember to assess the profit first, right? Whether it's sufficient to sustain the generous level of dividends that they are paying out. And of all these, as we shared earlier, the financial data and ratios, they only point to a certain direction, right? Don't never take them into absolute considerations when you want to invest in or identify a value stock, right? There's a lot of ways, a lot of angles to look at besides just financial ratios and analysis. You also have to look at publications from the annual reports or even press releases, right? You have to see that there's a big picture. What are they going to build in the long run? Is they going to build something impressive that is going to be the future? I think that's very important before you jump into a conclusion to invest your money in that or not. So the second approach I'm going to share with you here will be the DCA method. We call that the cost averaging method. Well, DCA means to consistently buy asset over a period of time with the eventual objective of lowering your cost per unit. So for the ease of illustration, explanation, I will illustrate it using crypto, Bitcoin, right? So over a period of 4 weeks, we'll be consistently buying 1 Bitcoin every week. So for the first week, you purchase 1 Bitcoin spot at 20,000, which is the current price, right? 20,000. Then the following week, you purchase another 1 Bitcoin at 19,000 where the price is softer. Third week, the price went down a bit as well, 18, and you bought another 1. So what happened on the fourth week? The market rebound to hit 24,000 and you bought another 1 as well. And in all, you would have spent 81,000 for 4 Bitcoins, which gives you an average price of 20,250. So meaning to say, based on the current value of Bitcoin at 24,000, you would have made 3,750 per Bitcoin. That's about less than 16,000 in all. right? So it's always good to accumulate in bear markets and start your DC in bear market because the price is lower. So when the price increase, it still help to bring down the overall average of your BTC. Oops. So for the third method is delta neutral trading strategy, right? This one refers to a non-directional trading in a hedge manner. You do not take bias towards whether the price is going up or going down. So what do you mean by delta neutral here is, for example, if you were to buy a Bitcoin, right, it will carry you one positive delta. And on the other hand, you short a Bitcoin futures, which will give you a negative one delta. So all in all, it becomes net zero, right? You net zero delta because positive one plus negative one give you zero. So the cash and carry is one of such a risk-free method that you can use to capture small profit gains, right? It's very easy to spot, right? But it only favors certain market conditions. For instance, this method will only favor the contango market condition. When we say contango market condition, it means that the future price of the asset is higher than the current price, right? So over here, the current price of Bitcoin, this is a screenshot I took this morning, was 20,630. Then this, the one in the middle, is the future contract price. It's a September contract, right? Then we have the December contract. You will take note that there's a price spread, right? For spot is 2630, then 2700 and 2850 for the further month future contract. So what happened is you have to concurrently execute both. So you have to buy one first, spot at 2630, and at the same time sell a futures, right? In this case we sell a 5-month futures, December expiry futures for 2850 for the premiums. So when the price merge, you have to exit both position and you will net off the premiums. So how is this possible, right? It's possible because towards expiry of the contract, it usually will merge towards the spot price. It will trade at the current price. But sometimes what happens if the market change direction, right? It become a backward market condition whereby the spot price is more than the future price, right? Very simple. If this really happen, you will just take profit on your spot price, right? Let's say hit 30,000, just close the position for your spot and close your position for your short futures. You would have net the difference. What do you use for collateral to short BTC future? I would say always use your stable coin as a collateral, because if you were to use a crypto asset like Bitcoin or even others altcoins as your collateral, what happens is when the market goes down, your collateral value also get compressed. Okay. Okay, so whether is it a bear or bull market, well, there's always a lot of opportunity for you. I mean, it really depends on whether you're able to spot them and how are you going to take action on that. So are options contract useful for long-term investors or only swing traders? Well, option contracts are, I'm not too sure whether you're referring to the option contract for the stocks or you're in commodities, or you're referring to the option contracts for cryptos. Well, because option is I would say, a very advanced instruments. Over here, we try to advocate, people to use simpler instruments because it'll be easier for them to maneuver. For options, if you are good in options, it's a good hedge. You're able to use options as a hedge. You can sell options for premiums, especially 5 months option, out of the money options, right? Especially, I would say, if you're selling 90% out of the money options between 42 days to 60 days, they'll give you relatively good premiums. But you have to think of the risk in option as well. So what happens is when your option get exercised, you would have to deliver. So if you are selling a put option, which means you favor the price to go up, right? Then if the price go down and go below your put price put strike price, then you would have to purchase the stock for that asset. Okay, so yeah, the takeaway here, recession will eventually end. The bear market always present you huge opportunity. So you always have to be very patient with it, because the market will not always stay at high or at the low. I mean, you never see the market move staying at a high forever and at a low forever. So what we want to do is be patient and always waiting for opportunity for the market to revert to its mean, right? So do you have any tips on fundamental analysis? What reports to look out for and what effect it has on different market? Fundamental analysis. When I say about fundamental analysis, I would say what reports. Actually, there's a lot of macro data that you should be looking at. Well, the CPI definitely is one of them. There's a lot including that. Let me see. I can't think off my head. Well, the dollar index as well. When the dollar index is strong, it's taking away a lot of liquidity as well, because a lot of this smart money is going into the US dollar bonds. They also weigh down a lot on, if you were to look at the fundamentals, also weigh down a lot on let me see how to put that. If fundamental analysis, I think John, are you referring to stocks, or are you referring to in general as the whole market? Yeah, so for stock markets, yeah, I think very good. I would say for fundamental, the indicator will be the various reports that's being published by the Fed. These include the FOMC publications, as well as the monthly. They have the monthly non-farm payroll, which will show the unemployment rate, the loan payout, and stuff like that. So what option? And sorry, Nathan, I don't quite get a question on what is LPING, LPing. Liquidity providing, which means you provide liquidity to the decentralized platform, right? I think you're referring to providing to the pairs, to maybe like Cake and Uniswap, right? Yes, but there is also certain risks. I mean, I would say the larger one will be safe. Uniswap and Cake will be pretty safe, because they are operating for a long time, right? And people trust them. The volume is really huge. But if you want to provide liquidity to these maker pools, then I would say to the larger, I would say to, in terms of maybe BTC or Ethereum pool, right? Because it's worth holding all these large cap assets as compared to the smaller one. Portfolio. Do you keep that in different Excel sheet? Yes. Because all your, okay, you have to keep them in a different Excel sheet, because your crypto asset is held in one account, and right, if let's say you are trading a stocks, you're on using some trading platforms, right? Typical stock trading platform, you have your asset there as well. It's good to keep a separate Excel sheet, so that you know how much you have total allocated in your portfolio. So for instance, you start off with 100,000 and you want to have a balanced portfolio. So 25,000 you allocate to crypto, 25,000 allocate to stocks, right? Then you make sure you take note of what did you invest in for your 25% of the stocks. You can update then as often as you exit a position. So how is profit? I would say the update usually is very manual. So for Rachel, how is the profit made in hedge trade? When you are in hedge, okay, I think let's go back to Let's go back to this delta neutral, the cash and carry method. So how the profit is made? So first of all, there must be a difference. There must be a spread, a premium in the futures contract, right? The 5-month contract. So in this case, if you look at the screenshot here, the spot price is 26,630, and the December contract is 2850, right? What happened is when the price merge, usually towards the expiration of the future contract, because this is going to expire on in December, right? So when it expire, the trading, the spot price will tend to track the future price when it's near expiry. So when that happens, you close both positions, and that's where you net the difference, the premium. A stable coin classified as cash or crypto in your portfolio. Stable coin I would classify as the same category as cash, right? Because with cash, you can buy stocks, you can buy bonds, right? With stable, you can buy your cryptos. If they are stake in earning, yeah, they are considered. You can classify that as bonds. It's the same category as bonds, but maybe riskier. I would say bonds is always safer. What if stablecoin is USD? Well, don't take USD, please. I only believe in USDC circle. They have been very consistent, and they just published a report that they are largely in US dollars, and only a small portion is in the treasuries. So in what scenario do hedge position make a loss? Well, when you are hedged, irregardless of the directions, you are not making a loss because you are hedged. So you go up, you're hedged, because when you exit together. Because either way, one of the side will be profiting and one will be taking some loss. So is there any more questions from the ground? Right, so always be patient. Don't have to rush into it. I mean, we won't know when is the bottom as well. So if there's no question, I think I will end my sharing and hope that some of the points here I've shared will be helpful to you. Where can I read more about hedge positions? Hedging, I can send you some articles. I will need to do some research first. So yeah, I think you can connect with me here. This is my LinkedIn profile. So I'm happy to connect everyone. So if just text me, I will send you the link whereby you can read more about hedging. Indicators, I believe you are referring to swing trading. Indicators, I don't really use indicators because indicators can be delayed, right? Especially for RSI, they are a lagging indicator. I'm more of a statistical, probabilistic person, so yeah, I don't use indicator. Because when you say you are using indicator, I suppose you will be going into a speculative, right, position where you think that, oh, is it the right time to buy the market, or is it the right time to sell the market, right? So indicators, there's a lot in the market. MACD is a very common one, but no, I don't use either of them. Moving average, you can look at the 200 moving average. I think it might be okay, but it's still delayed for moving average. Always use it as a reference. I would not say absolute, just a reference. Any more questions?
Any more questions for Shawn? Please feel free to unmute yourself to ask or type in the chat. Otherwise, we will end the sharing in a few minutes. Awesome. So thank you so much, Shawn. I think no other questions from the ground. If you have questions, feel free to add Shawn on LinkedIn, and then he can share more as well.
Okay,
All
thank
right.
you, Yunhan. Thank you,
Thank you so
everyone.
much, Shawn. And thanks everyone for joining us today for the Lunch and Learn. And we will end the sharing now. Thank you. Feel free
Thank
to
you.
connect with Shawn if you have more questions. We will also share the slides. Faye will help to share the slides for this after as well.
Sure.
Thanks, Shawn.
Thank you, Faith. Thank you, Yunhan.
Thank
Thank you,
you.
everyone. Bye-bye.
Bye.